The biggest problem with Roth IRAs, whether you're contributing the normal way or through the back door, is just how little you can get in there each year relative to what you'd like later in life. 6,000, 7,000, 8,000, or whatever it grows to be in the future just isn't enough. It's great, but you want more. And who wouldn't? I'm right there with you. Well, for some lucky and responsible high-income earners, there is an option during your working years that will allow you to save up to an additional $46,000 into a Roth account every single year. That's $46,000 in addition to the $23,000 you could get into a Roth 401k and $7,000 into your personal IRA. Let's dive in. Welcome back to the coolest 18,000 financial minds on YouTube. For those of you who don't know me, my name is Steven Spicer, and it's my goal to help you not get killed in taxes and to overcome the significant risks to which mainstream advice leaves you exposed. In this video in particular, we're exploring more ways you could potentially sock away even more in tax-free assets, a gift to your future self. Now, if you're not familiar with how and why a backdoor Roth IRA contribution works, you may want to check out this video as well. Because traditional IRAs allow you to convert funds into a Roth account in a very similar way as do traditional IRAs. The reason this is appealing is because the contributions here are way higher. And we're not just talking about the salary deferral limit here. There's more, but we can start there. The contribution limits for 401ks in 2024 is $23,000. And then an additional $7,500 catch-up provision for those 50 and older, totaling $30,500 each year. But wait, there's more. Beyond that, the traditional 401k part of your employer plan may allow for after-tax contributions, similar to how traditional IRAs operate. The IRS has a total contribution limit that changes each year that refers to the total amount you can get into your plan in a given year across all the various buckets here: the traditional portion of your 401k plan, the Roth portion, any after-tax portion, and the employer's contribution match portion. That total contribution across all those buckets in 2024 cannot be greater than $69,000. Or if you're 50 or older, it's $76,500. Thus, the maximum after-tax amount one could contribute if the stars align, and we'll spell out those stars here soon, is $46,000, regardless of age. $69,000 minus $23,000 and $76,500 minus $30,500 for those 50 or older both leave us with $46,000. That being said, you would also need to factor for any employer's matching contributions, which are even better because the employer is funding those, but those will also eat into your total here. So if you're making $400,000 and your employer is matching dollar for dollar up to 5%, and you're maxing out what you're allowed to contribute, let's say you're relatively young in this example, so $23,000, that means your employer's match will be $20,000. Now your after-tax limit is going to be that $46,000 minus their contribution of $20,000, leaving you with only room for another $26,000, right? You take the total contribution limit, $69,000 or $70,500, and subtract your 401k contribution limit of $23,000 or $30,500, leaving you with $46,000. And then you further subtract out your employer's contribution match, whatever that is for you, and that leaves you with your potential Mega Backdoor Roth limit. This is all great when you can turn right around and do a Roth conversion, which the process for that was much simpler with IRAs than it is for 401ks. So let's get into some of the details. Now, it used to be that anytime you would try to convert this after-tax 401k money into a Roth, you have to take equal portions, pro-rata, of the after-tax and of the pre-tax amounts, similar to the IRA aggregation rule we discussed in our video on backdoor Roths. Anyway, if we had to do that here as well, that would make this a very inefficient thing to do. That's how it used to be, but today that's not the case. That rule changed back in 2014 with IRS Notice 2014-54, which allows those after-tax dollars to be separated. With that, you can do a very straightforward Roth conversion with just the money you put into that part, the after-tax part of your 401k plan. Let's look at an example of how this could work. Say you have a $500,000 401k with $50,000, 10% of that being after tax. If you take a $500,000 distribution, you can literally request it be split into two different checks: a pre-tax check, $450,000 in this case, and an after-tax check. You can take that pre-tax check and roll it into a traditional IRA. That's a normal rollover, it's not untaxable. And you can take the $50,000 after-tax check and you can put that into your Roth IRA. That's a Roth conversion. It just converted from your traditional 401k into your Roth IRA. And since all the money here is after tax, it's an entirely tax-free conversion. And now, from this point forward, every dollar of growth will be tax-free inside of the Roth, adding nothing to your tax bill ever again. The beauty of the Roth accounts over the traditional accounts. Because you already settled up front with the IRS for these retirement funds when you paid the taxes on the front end of these after-tax contributions to your 401k. Now, if you've had growth on that after-tax portion of your 401k, you can separate that out as well, because that growth has never been taxed. Or you could go ahead and convert it into your Roth and expect just that growth amount to show up as ordinary income come tax time. Now, here's one of those stars that needs to be aligned for you. For this to be an option, your 401k plan has to allow for those after-tax contributions. Not all plans do. The IRS dug into this about a decade ago, and this is what they found, that you're much more likely to see this at very large firms. And even then, we're not talking about a majority here. But remember, this was years ago, so this figure is likely quite a bit higher today. And these very large firms here represent millions of people. So it's certainly worth checking. If yours does, and you're looking for more ways to save, this can be a great option for you to consider. You can begin making those after-tax contributions today with the plan of converting later. And that brings up another feature you may or may not have access to with your current employer: in-service withdrawals. Every firm has to allow withdrawals when you reach the age of 59 and a half, even while you're still working. But most will allow for even more. The details, however, of what your plan specifically can do will vary. So you'll likely have to dig deeper into your benefits paperwork or work with a trusted advisor to help you get to the bottom of that, or check with your plan administrator to confirm the specifics. Some will allow for in-service withdrawals to a Roth IRA. Other plans allow what are called in-plan rollovers. This will allow you to regularly convert those after-tax contributions from your traditional to the Roth part of your 401k. Some plans will even offer an auto-convert feature that will just automatically convert all after-tax contributions to your Roth 401k. But if your plan allows for neither of those, the after-tax contributions, the in-service withdrawals, and you are below the age of 59 and a half, your opportunity to do the Mega Backdoor Roth is delayed until you either hit that age, 59 and a half, or leave your job. Depending on your unique circumstances, that may render this strategy not quite as attractive as it may have otherwise been. You always have the option of waiting until you retire, turn 59 and a half, or leave your current employer, and then just roll over your entire 401k balance, requesting separate checks as we discussed earlier, putting the after-tax portion directly into your Roth IRA, converting those funds in the process. But as with anything, when it comes to tax law, delaying like this comes with its own risk. The IRS could change the rules here. And once again, don't forget that any gains you have on those after-tax contributions, because in this case they've been sitting there for a while presumably, before converting them, they will be taxed. Depending on how long those contributions have been sitting there and growing, that could be negligible or somewhat significant. Just something to be aware of. Now, there is one big caveat here. Although the checks can be split, making it easy to put the after-tax amount with your Roth IRA and the pre-tax amount in your traditional IRA, each distribution from your 401k comes out pro-rata. That can be confusing. Here, the IRS pretty much has two steps here. They view it as two steps in their mind, right? The distribution from your 401k plan and the contribution into your various IRAs. They let you split the funds in the second step, which is nice. but only after taking out a pro-rata distribution. In other words, from our example from earlier, you wouldn't be able to just say, send me my $50,000 of after-tax contributions, please, and nothing else. In the IRS's view, the $50,000 distribution you receive in this case would be pro rata. Remember in our example, only 10% of what you have in there is after tax. So of that $50,000 distribution, as far as the IRS is concerned, only $5,000 of it is after tax. The other $45,000 of your after-tax funds stayed in your 401k. The only way you're getting all of it here is by withdrawing the full amount, the full $450,000 that's left, or the full $500,000 that we started with from your 401k. Now it's the second step where Notice 2014-54 comes into play. That is what allows you to then split that pro rata amount. Now you can have a $45,000 check that you put into your traditional IRA and a $5,000 check that you add to your Roth IRA. So to maximize the Mega Backdoor Roth strategy, you can contribute after-tax dollars up to the IRS's total contribution limit. But this is only relevant after maxing out your salary deferrals. You, of course, must actually have more salary to then contribute. Also, critically, your plan must allow for after-tax contributions. Now, if you're at a smaller firm, those can be added. Like if you're a small business owner watching this and thinking about the possibilities here, for small businesses, you need to watch out for the actual contribution percentage ACP testing. It's much easier for the highly compensated employees of a small company to be in violation of that rule than it is for those at a large firm. They don't really have to worry about that. So if that applies to you, just be aware before making any big changes with your 401k plan. And then with any of this, you should always be aware that the IRS, as I said before, could close the door on this strategy at any time. So if you can do the Roth conversions now because your plan allows for in-service distributions or whatever, great. If not, that's just another variable for which you'll need to be prepared. Obviously, there's a decent amount of variability here around how different 401k plans are structured, but I hope this video has helped you see what's possible and know what to look for as you consider your own unique situation. I look forward to any additional questions you have in the comments, or just a hello. That's always nice as well. I sincerely wish you all the best. Take care.